Good evening, everybody. Stanley here, and welcome to our Premium Club webinar number 36. And today, I have created a webinar that would go a little bit deeper into my stock picking process. And we'll look at two major types of companies that I generally look at: a turnaround situation and a growth stocks. And these two, we will have real life example and then showcasing what are some of the similarities and differences between the two of them and how we can think of each category in terms in our portfolio. All right. So without further ado, thank you so much for joining me tonight, and I hope you guys had a good dinner, and we're ready to get started. So let me just pull up my screen. Webinar number 36, turnaround versus a disruptor stock. What should we be looking into? Oops. Give me a minute. Right, let's go. Of course, as always, just a quick disclaimer that this webinar is created by myself, and all the content and research is done on my own. So these are just my personal opinion and doesn't represent that of my company, which is iFast Global Market. And of course, the material that I'm going to show you today does not constitute as investment advice. It's more for your educational purposes. Please do your own research before investing, or you can talk to me directly to have a more personalized financial planning for yourself. All right, and welcome. My name is Stanley. You can find out more about me and what I do from learnwithstanley.com. I'll have my profile up there. But this is a webinar that I'll do every fortnightly. And some of the content that we will showcase would be either analysis about stocks or funds or ETF, some about market update, but also touching on some personal finance scenario as well sometimes. So as I explained just now, I work for iFast Global Market. And if you have never heard of us, we are actually an investment platform. And the most common ones that you can use us for is a stock brokerage platform. And we have access to most of the major markets around. But on top of that, we are a advisor assisted platform. That means that I will be there to help you and guide you along the way to build up your portfolio. And we have access to most of the asset classes that you need to create a diversified and long-term portfolio for yourself through unit trusts, through bonds, our internal managed portfolio, even as just cash management for yourself or even for your company, and of course, stocks and ETF access as well. And something that I do for some of my clients is using a more systematic and software-driven approach in financial planning, running out scenarios for them on their own financial objective, and simulate out what could be the possibility that they're going to face to reach that financial goal, and how to plan a portfolio around it so that they can reach their individual financial goals in the future. I myself has been investing in the stock market for close to 16, 17 years now, since 2007, 2008. And my own personal philosophy has always been long-term investing and looking at high quality stocks or funds that will continue to grow through different market cycle. And so far, it has worked pretty well for me. And I like to share the information that I have gathered over the past close to 2 decades with everyone, just to see if it's going to be suitable for your own investment as well. But if you want to have a one-on-one discussion with me, feel free to fill up our Google form here, or reach out to me through my contact with learnwithstanley.com, and we can have a more personalized discussion one-on-one for you. Okay, so today, let's go straight into what we're going to discuss, which is I'll first touch on a little bit about what are some of the characteristics of good turnaround stocks. What I call it the anatomy of a turnaround stocks. And then we'll go into a real life case study of a company that I'm researching on right now, which is called Restaurants Brand International Inc. And how this company came about and why this could potentially be what we call a turnaround opportunity right now. Next, we'll contrast that with a high growth disruptive business that is trying to change the way the industry has always been working. And then we'll compare the two to see where we can find similarities between these two business and what are the key differences, what are the risks, what are the rewards we have to look out for when we're looking at this kind of stocks. All right. If you have any question at all throughout the presentation, feel free to just pop up your chat box. Why don't we all try it right now? Pop up the chat box and tell me what are some of the examples of a good turnaround stocks and a good high growth stocks that you have come across. Why don't you share that with all of us and we can have a discussion, as I'm talking about. You feel free to put in your question and also your opinion on some of the things that we have discussed. So let's get started. So what constitutes a beautiful turnaround? If you guys recognize this device, it's one of the first Apple computer, and I will see. Let's go down into the details. I feel that Apple has gone through so many cycles that we can through the history of Apple, we're able to see what constitute a not so successful turnaround and what constitute a successful turnaround just from the history. And I'll start with the era during the 1983 to 1985, where basically Steve Jobs and Steve Wozniak has already created Apple. It was an initial success. They created the concept of personal computing. And now it is more structured, and Steve Jobs at age 28, basically after it IPO, they have to have a formal board, and the board recommended that he find someone more matured to run the company as CEO. And because he was still considered very inexperienced in running a listed corporation. So he brought in this guy, John Scully, which was the previous CEO of PepsiCo. And at first, they have a very good relationship. But then, around 1984, 1985, where the sales of Apple started to go down with increased competition coming into the market because they see the success of Apple and all the new first movers, and now more and more companies are coming in to compete in this personal computer space. And at the time, there's still no real clear winner, and so it's a free-for-all market, very, very competitive. And Apple sales, basically the two computers that they came out with, Lisa and the first Macintosh, wasn't doing very well, right? They have a sales target of, I'll just give you an example from my reading. They have a sales target of around 75,000 units to be sold every single month. And the Macintosh basically fall flat on that. It was only selling around 20 or less than 20,000 every single month. So when that happens, Apple fall into the first crisis. And basically, they try to blame Steve Jobs. And John Scully got Steve Jobs demoted from his role to just new products, just monitoring the new products launch instead of managing most of the company. So Steve Jobs was very angry, and he tried to go around and try to get John Scully sacked. But instead, what he found out was the board actually sided with Scully, and there's two different versions of events. If you believe the story from Steve Jobs, he said that he was sacked from the board. But if you believe the official statement from the company, is that Steve Jobs decided to quit the company. If you have seen some of the speeches from Steve Jobs, especially the most popular one, his commencement speech from Stanford. He has gone through. He will explain this period of his life where he left and then he went on. After soul searching for a while, he went on to start another computer company called Next, and then also bought and invested into Pixar animation. So that was a period of his life. And then, of course, he later returned to save Apple. But from that commencement speech, especially when the first time I was watching it, I thought this happened quite fast, right? He was out, he tried something, a few things, and then it works, and then he came back. But actually, the whole period where he left until where he come back, it was 11 years, right? He left the company for 11 years. And during that period, especially at the beginning, he was seen as a public failure. He talked about that. And it took him quite a long time, a decade before he proved to the market and to himself that he can create other great companies. And during that period of Apple, it was met with a lot of struggle. And by the time when Steve Jobs returned near 1997, Apple was at the brink of bankruptcy. And so what happened was after Apple, uh, after Apple kicked Steve Jobs out, uh, John Scully basically his strategy for that transformation period that he feel that we should focus on the competition. So the main competition at the time was IBM with IBM personal computer coming out, and John Scully actually resides during the period where Apple sees their fastest growth ever, right? For the period. I think their sales grew, from less than $1 billion to multiple tubes of $1 billion within his tenure. But what happened was he was focused mainly on competing with the competition. And with so many competitors, it means that it is a race to the bottom, right? By 1994, before 1994, 95, the net profit of Apple was actually at 3%, right? Let that sink in. The net profit of Apple is 3%. If you compare it with today, Apple is a very, very different story. This means that the Apple at the time don't really have any pricing power in the market as well. It's just another computer. And at first, when sales are growing fast, they were doing a lot of marketing, trying to sell the computers. Everything was still okay. But within a few years, by 1999, 1991, sales has stagnant. The market has matured a little bit more. Margin was very, very bad. And sales started to slow. And once the sales started to slow, the board decided to get rid of Scully as well. So then they promoted one of the internal manager to the CEO role, but basically it was not able to turn around the company because they're just focusing on trying to compete with the competition, doing whatever that the competition was doing. Before Apple brought back Steve Jobs, the new CEO actually tried to sell Apple. So during that period, 95, 96, Apple was actually actively trying to sell itself to another competitor, mainly IBM. But of course, we know that that didn't materialize. And during that period, for the 11 years, the stock price actually still gained 100%. But this was reaching the point where the news came that Steve Jobs was coming back. And if you count back that 11 period where he was 11 years where he was away, the stock gained 100%, which translate to about a 6.5% return year on year over that same period. Not that great, especially during that era was a relatively high interest rate environment. So all things equal, it was not a great period. But if Steve Jobs did not come back, there's very, very high likely case that Apple computers would be completely bankrupt without him. So the real successful turnaround transformation comes when Steve Jobs returned to the company. And basically, the computer company that he has created next, Apple uh, bought next for a deal. I think it was a stock deal, and Steve Jobs was made CEO. Previously, he just came back as interim CEO, but then he just stayed on as CEO. And some of the very very key things that he changes in the company that led to the transformation um, during his period is that number one, he simplified the product line drastically. So he cut all the things that he feel is non-core as a product or is a very highly competitive market that is useless to be in. He cut everything and go down to the core few products that he feel is important. And then he focus back on the development of software and hardware integration, meaning to create the ecosystem that Apple is known so well known of today. And one of the key things that he did was that he restructured how the company is being managed, right? I put it as restructuring the financial management. So in the past, Apple was segmented to business unit. So someone will be controlling, for example, the iPod. Somebody will be. I don't think iPod was created back then, but say somebody will be focusing on the laptop. Somebody will be, or a business unit will be focusing on the desktop, and that led to competition within the company. And each of them are not cooperating with each other, not collaborating, but rather see each other as a rival, a business unit. They're trying to top one another. And the genius thing that Steve Jobs did was he get rid of all this business unit and restructure the company in terms of function. So everybody is working towards one income statement, the income statement of Apple. And everybody should be helping one another, regardless of whatever products that you're working on. And I think that was one of the very, very key thing that he changed the mindset and the incentive system within the company. And then, of course, he got a key investment from Microsoft, from Bill Gates. I think it was 150 million investment from Microsoft into Apple, which was a lifeline. And in return, he allowed Microsoft Office to continue to be an application on Apple OS. And with that, he stabilized the company and refocused the development into new innovation and creating more and more services and software that ties together with the hardware to create this pricing power and this brand value that we see Apple is today. So he basically created the foundation of what Apple is today. And that innovation led to the invention of the Mac OS, the iTunes, and how he disrupted and changed the music industry, and of course also the App Store, iClouds, and iMessage. All was during his period of time. And if we see his tenure, by the time where he chose to step down because of his health issue, during that 15 years, from 1996 to 2011, it is roughly a 9,000% gain in Apple stock price. So that was a 90 times gains. And for the 15 years, it translates to basically during his period, Apple grew 35% a year, year on year, for that period. That includes going through the dot-com bubble, the global financial crisis, all the way until he left the company. And what is interesting is I wanted to show also what happened after he left, right? After he left, it kind of show us that the company that he left, uh, Tim Cook with, was a very, very structural sound company because a lot of time with highly charismatic founders, when they leave the company slowly also disintegrated over time. But yet, that has not been the case for Apple. Um, and Apple, instead, under Tim Cook, has also seen tremendous growth. And the stock price over that 14 years gained another 2,000%, another 20 times. And that translates to roughly about a 24% a year-on-year return under Tim Cook. So these are, I feel the story of Apple highlights some of the key things that is quite interesting when we are looking into figuring out whether companies now that are in turnaround uh, has some chance of really turning the ship around. And some of the summary that I feel, at least from the Apple example, is that we have to see that the leader has a clearer vision of what the company should go towards instead of merely trying to go with the market, right? When you're turning around your company, it means that the company itself hasn't been doing that well under typical market condition. And that is why it brought you to the place where you need to turn it around. So when the new management comes in, they need to have a much clearer understanding and much clearer vision of how the company can really differentiate itself from the crowd uh, and position itself differently from competitors to have a possible turnaround opportunity, right? So that leads us to look into the story of Restaurant Brands International, a company that I have been looking at recently. And I haven't, okay, as a caveat, I haven't decided whether that this is a company that truly constitute a turnaround situation, but it has some interesting aspect of it. And I hope we can have a discussion today, right? We can have a vote later that you tell me after I tell you the story of Restaurant Brands International. Do you feel that this company has the potential to be a turnaround situation, or do you feel that this is a company that we should all just avoid? Okay. So before we begin, why don't you guys put down on the chat box? Have you heard of this company, Restaurant Brand International? Right. Type one if you have heard of it, or type two if you have not heard of them. But when you look at the brands that they hold, hopefully you have heard of them. So they are a quick service restaurant chain, and they have four key brands today: Tim Hortons, Burger King, Popeye, and Firehouse Sub. And the story goes that Burger King before 2014 was already facing a lot of trouble, both internationally and also domestically in its business. Burger King was founded, I think, in 1967, And it gone through a few merger and acquisition and gone through a few owner changes. And by 2010, it was bought by a company called 3G Capital in 2010. And they tried to restructure it. And then by 2014, they merged it with a Canadian coffee chain called Tim Hortons to form a Restaurant Brand International. And that's how the company came about. And then throughout the next few years, they have acquired different brands, major two brands, which is Popeye and Firehouse Sub, into their portfolio. And I think that will be their strategy going forward, right? They're gonna grow, revamp, and then acquire again, then do that, repeat and repeat and repeat again, and go for more and more brands under its portfolio. I would say the most equivalent kind of company to look at with this company would be Yum Brands, right? KFC and Pizza Hut and Taco Bell. Those the business model will be the most similar. Now going back into each of their key brands, uh, Tim Hortons, you can see it as like the Dunkin' Donuts of Canada, maybe. If it's in our Malaysia context, maybe now like Oriental Coffee, just the local coffee shop for the population. And they have the leading market share in Canada, but also expanding in the US. And these are just fast food, uh, donuts, coffee, everything that you need for a quick meal. And the next one is Burger King. And Burger King is the main crown jewel of the whole business. Of the 30,000 plus store that they have, around 19,000 is actually Burger King stores. So this is the biggest business in their portfolio. And it is very, very much focused on expanding the brand internationally. Next is Popeye. Popeye would be focusing more on chicken and fried chicken. So you can see this as a direct competitor to KFC. And Popeye was acquired by the company in 2017 um, to expand its uh, portfolio. Right now, it's mostly still in US and Canada at the moment. There's still a lot of places, a lot of range to grow just domestically in these two markets, and so that will be their main growth factor going forward for this chain. And the last one is Firehouse Sub on on sandwiches, and this one is also uh, the smallest of the group and predominantly still just in US and Canada, and they would be planning to grow mainly in the local market at the moment. So you heard me saying about 3G Capital previously. And so who exactly is 3G Capital? I think we have to understand 3G Capital to understand this business a little bit because this is not the first deal that 3G has done. 3G is the brainchild of these three gentlemen. I'm not sure if I can get their name correct. I'll not try to pronounce their name. It's a little bit hard for me. But so basically, there are three financier, banker, and they come together to form this private equity firm. And this is actually not the first deal that they have done. They have done many, many high profile deals. And when I go through some of the deals, you would recognize uh, their key strategy on how they go about doing things, right? So the first major deal that you might have heard of them doing is AB InBev. And AB InBev has a large portfolio of beers and uh, alcohol beverages. And this is a company that they started in 2004 by acquiring a brewery in Brazil called Ambev, right? So the three gentlemen is actually all Brazilian, and they're all high profile investors and financiers in Brazil, and they took over the largest brewery in Brazil called Ambev, and then in 2004 they merged it with Belgium Interbrew to create InBev in 2004, right? And from there, they basically put the company into a lot of debt, right? They pile on a lot of debt for the company, and then they have operationally they'll go in and cut out all the excess, right? And they have very strong uh, mandate to cut and streamline the company to become more efficient. So they're very ruthless in doing that and in creating operational excellence and operational efficiency. And once they do that, then they pay down the debt, and then they by 2008, uh, InBev acquire the U.S. brewery Anheuser Busch, which is the brewery of Budweiser in 2008 for 52 billion to create AB InBev, which is becoming the world largest brewery, right? So through that acquisition, they created the largest brewery in the world. Again, to fund that investment, they take on a lot of debt again, go in, cut out the excess operational fat, and try to pay down the debt, and then do that again. And I think 2011 or 2012, they did that again with SAB Millers for another, uh, I think it's also 50 billion or something, to form even larger group, AB InBev, with a market cap of more than 100 million. So that's when they become the largest alcoholic brewery and alcoholic company in the world. I think today they can be considered the second one. The most valuable one would be China Guizhou Moutai. But yeah, when you're talking about alcoholic uh, companies, this will be the biggest of the biggest. And so you will see that their strategy comes of have rhymes on each deal, and after that deal, they did another major deal with this gentleman called Warren Buffett or Berkshire Hathaway. And in 2000 and let me see my notes here. In 2015, I think. So before that, 2008, they bought another company called Kraft, right? And by 2015, they talked to Buffett to acquire Heinz to form the company Kraft Heinz. So these are consumer staple companies, from your cheese, your cereals to your ketchup, everything. And they did that again by putting in a lot of debt and, of course, funding from Berkshire, going in aggressively, cost cutting the whole company. That's their playbook, right? Prioritizing, improving margins, and creating very lean management and aggressive cost cutting. And from that, try to pay down the debt again and to create value for shareholders. And so this is actually the third major deal that they did with Burger King, through Burger King, because in 2010 they invested in Burger King, did that whole exercise with Burger King, and then in 2014 they have paid down enough debt that they can take on more debt again to merge with Tim Hortons to start this cycle again. Okay, so you can see that they buy, they leverage it, they clean it up, and then they merge again, and they keep repeating this cycle over and over and over and over again. And they have did that to restaurant brands as well. You can see this is their leverage uh, gearing ratio. When they started with Burger King, they leveraged it up to 6, 7 times. And as they improve the business, they pay it down. And once it's a little bit down, they do it again and push it back up again to acquire and merge with Tim Hortons. And then they pay it down, then they increase again, they pay it down, and then they increase again, and they pay it down again. So that's the game that they play. Uh, if you ask me for my view, it's a little bit too risky for me, right? And when I'm looking at it, I actually invested in a Craft before when they did the deal. I would have to say it didn't work out well, right? I have to cut loss after a few years. It didn't go well. And to me, I feel that they are a little bit too aggressive when it comes to leveraging up um, and trying to cut down the fat of the company to make it work. But so far, it has been working for restaurant brands because restaurant brands is mainly a franchise business. So more than 98% of all their stores are franchise. And so they have a relatively asset light business that is also enjoying a pretty high margin for them. So it's able to generate good free cash flow for the company. And they are not too worried about uh, they're not too worried about like operational costs that will balloon too high for them because most of their business revenue still come from franchising fee. Sometimes they might even build a property portfolio by investing in the property that all these restaurants are on and then subletting it to the franchisee of the business. So these are some of the things that they can do. And I feel that they are using this company to aggressively leverage up, but also get back as much cash return from the business as well, which is why over the past decade, they have been increasing their dividend consistently uh, over time to make sure as long as the company can sustain it, they have been paying out more and more and more dividend to shareholders. So the dividend that is being paid out over the past decade is actually already more than the market cap of the business. So you can almost see it as a dividend play, but this in this industry is what we call a leverage buyout and a very, very typical strategy of private equity firms where they leverage up the company and then use the company profit to pay down the debt and then extract as much cash as possible back to shareholders to get the return. So far, the business has been shown that it is working. This strategy has been working. And because they focus on franchise model rather than operating the business itself, they have much lower capital base that they need to expand and a very, very recurring income from franchisee. They over the past decade they have issue with some franchisee as well, but to them is quite simple. They cut off the relationship or they buy back the stores and then re-franchise it again to new partners. They did that in China, and they did last year. They bought over one of the largest franchisee in the US, Carol's, and they're trying to find new partners again to franchise out the restaurant under their care right now. So, and through adding more and more brands, in a way, their supply chain has some economic of scale in terms of procurement, but also in terms of advertising as well for the company. So they are able to find some synergy there and some scale there. And last thing that I like about them is their global strategy. So basically, they acquire all these iconic US and Canada brands that is, you would say, maybe not still not super famous outside of the US and Canada, uh, except for Burger King, of course. But they are trying to bring those brands out to the international market. So that has been the brand. That has been a key strategy to them, and the way they do it is they just have a country franchisee, so they won't go and manage the franchisee in every individual franchisee in every country, but they'll have a master franchisee in each country to help them roll that out. So as a company now, I feel their strategy is more or less quite stable and has proven that it works. They have very, of course, aggressive management that 3G is still quite actively involved in the business. There are some skills, economic scale now in the business in terms of sharing some costs. But there are also weaknesses, the way I see it, that they're still in the restaurant business and there's not much differentiating factor, regardless of brands that you want to share, right? I would say that restaurant business typically has very, very low switching costs for customers, and uh, there's not too much differentiating factor. And it comes down to a lot of constant marketing and constant price war between restaurants. So it's going to be competitive all the time. And they have taken on a lot of debt to do that. But the opportunity just now we talk about is that number one, they can go global on all these brands. And also, as they pay down their leverage, they would most likely continue to buy more and more brands to acquire and build the business that way, right? Oops. That's our next company that we're going to talk about. But I would just share quick one with you guys on. Let me see. Oops. The financial statement of this company. Let me see if I can pull it up. Okay, much better. So I'll just go through a little bit about their financials with you guys. As you can see that they have been able to grow the business over the years. But what is something that I want to highlight to you is that since before COVID, their revenue has not grown significantly, right? From COVID, you can see that it's already reached a gross of 3 billion. And now they're just coming back to the $3 billion mark. A few things to highlight is that uh, I feel that these are just more or less temporary, as they are doing a lot of renovating on many of their old stores, and they're giving incentive to franchisee to revamp some of their old stores. Like basically, they say that they're gonna finance the renovation. In turns, then the revenue share with the franchisee will increase a certain percentage point. So basically, they're financing it for the franchisee, and with that strategy, meaning that once everything is done, when they roll out the new restaurant, and also improving on some of their back end technology, we could see an improvement in their sales as well, in terms of their profit. That's number one. And I also feel that because of the additional capex that they are doing right now, that is dampening some of the net profit of the company. So these are some of the things that we can highlight. I want to highlight to you that when you look at it, it seems that they haven't been growing for some time, right, over the past 5 years. But generally speaking, I would say that if you take a longer period viewpoint, they should be able to continue to grow at a moderate pace, right? This is not going to be a company that will grow fantastically fast, but in a relatively moderate pace, less than 10% maybe, I think it's still very, very much doable. So that's the first company that we want to look at on understanding a turnaround situation. The next company I will share with you guys is, you saw it a little bit just now, Futu Holdings, which is a financial company, and it is the company behind Momo. This is a company that I invested in myself, and I've been monitoring it for quite some time. It is also a company that I have already shared in webinar number 16, so almost a year ago, right? Almost a year ago, yeah, almost a year ago, and we can look at the stock price. How's it doing? So over the past year, over the past year, roughly, I think 20 weeks ago, yep, that has been uh, how the market has done for this company. But it looks impressive that they have grown quite a bit during that period. But I would say that that links to the growth, number one, in the recovery of the Chinese stocks. And also, when you look at their financials, you realize that the stock price is actually still lagging behind how well the financials is doing a little bit, right? We'll share a little bit more on that later, but I would quickly run through here the key points to touch on for Futu and why it is considered a very high growth disruptive company. So, Futu is founded by this person, Leaf Lee, and he's the disciple of another guy with a funny name, Pony Ma, right? He's Tencent's employee number 18, and he's very instrumental in Tencent, but he left to create this company, and it almost go one full circle because Tencent, Pony Ma, when you look through his history, when he was still studying, one of the first business that he created was a financial database platform, and he basically sold that platform, I think, for like 50,000 or 60,000. That was his first entrepreneurial business, and it goes one full circle with his employee number 18 creating Futu Holdings, which is Momo. And Tencent is also one of the key investor in this company. So basically, for a disruptive company and a high growth company, what they're trying to do is, there's always something that is inherently a bad experience or doesn't make sense, right? It's not running things, something that is not running as efficiently as it can, uh, and they found a better way to do it. And so in our side of the world, let's not say US, right? US now has brokerage that is charging you zero brokerage fee, and very, very highly integrated and easy, highly integrated, and also highly competitive. But at least in China, that was not the case, and it's very bad. In China, it was a very bad experience in opening brokerage, and tend to have typically very high fees. And even for our site, only these few years that we started to see better fee structure and friendlier interface for investors. Partly driven by company like Mumu, but also iFast ourselves is at the forefront of improving that experience as well, right? And so the idea for him was that he can bring the idea that he knows so well on in Tencent, which is the social media side of things, to stock trading, like how to make stock trading more interactive, more user friendly, and more like a game. So he take that risk, And he tried to solve this problem uh, by going through the brokerage industry first. So to them, the ideal customers is someone that is professional, already high earners, hopefully someone that is comfortable with tech and ready to try new things, and someone that is wanting to trade internationally and want the social element of the app. So from there, they release the app Mumu. If you have used it, you can you try it out. I myself had tried it out just to see, how is it different from our own app. But I would say as a DIY platform, it is quite intuitive. Maybe a little bit too many functions, I would say, for especially for beginners. But if you know what you're doing, if you want to do it yourself, I think that it's a pretty good app to do. But it does encourages trading activities, right? And to them, that's what they wanted to do, to to encourage more trading, to make it more fun. Like trading is a game. That's not really the philosophy we have in iFast, but in terms of as a business for them, it must be great. And so from there, they really grow very, very fast. They grow very fast together with other Chinese brokers like Tiger Brokerage. They grow extremely fast, and many of them are using them to trade outside of the US. So they reach to a point where it's so big that the government has to clamp down on them to not allow them to encourage people to invest outside of China because there's still capital control in China. So that's where they started to really expand overseas, right? You can see that after that news, their stock price really crashed. But then they have to turn it around, and what they do is they focus on other markets, which is why you see them expanding so aggressively in our region, in other markets as well. They are today in US, Canada, Japan, Hong Kong, China, Singapore, Malaysia, and Australia. I'm sure they're going to add more and more things, market into them as well. So they're going to take that strategy and go to all the underserved markets that they can find and compete there, right? Interestingly, when I look through their financials, a big part of the business is still coming from lending, so from margin financing. So again, this goes back to their strategy of encouraging trading through margin financing and easy to trade. So from all that, uh, if volume increase, if people lend money to trade with them, that's where they earn their most money. And for a typical investors, definitely not like you guys, that we're all long-term investors, that we know that there's no point in trading in and out of stocks so often, that it often actually leads to more mistake than we want. And so we are not ideal customers for them, I would say. But for the general public, that's a game changer, and they have been extremely effective in growing that market. So you can see that their revenue just from a few years shot up to extremely high, about 10 billion Hong Kong dollars in 2003, and this year again growing um, more than 50%. So a big part of them growing so much is marketing as well. So if you are ever online and if you just search, stock trading and anything, I'm sure you'll be targeted by Mumu on their trading platform. And because their platform is has a social element, they encourage a lot of influencer to share ideas within the platform, to share their apps. Most of the financial influencer that I follow on YouTube, I would say 80% is sponsored by Mumu, right? So they're very aggressive in their online marketing. Plus, they have very low fees and incentive to get you hooked and get started on the trading. So that's a key mode of acquisition for them at the moment. I'll not go through all this, but you can see the different things that we talk about between this company and also just now restaurant brands. Something that is different that you will see is that the profit and revenue typically grows at a much faster rate because they are changing the entire industry, and the margin tend to fluctuate a little bit more. For a company like restaurant brands, you can see that their margins typically, at least the gross margin, would be quite stable, and their revenue will not be growing as fast. And another thing is typically a startup company like Fudu, they would have lesser gearing compared to a turnaround company. They will mostly be funded more on the equity side. So some of the key things I think I wanted to highlight to you guys is when you look at a turnaround stock and a new disruptive startup, is that we have to understand that both are considered what we call a high risk stock, right? These are stocks that I will not put them together as our blue chip of today. Companies that are already stable, doing well, and growing in a matured stage. These two are more of a binary chance when you invest in them. Both has a good chance of going to zero, and both need to build up their economic moat again, meaning they have to find the version of the future that they have a place in. And the management must be very, very adaptable and accept change. And especially in the turnaround case, if they cannot accept change, especially because a lot of the management and a lot of the people in the company are the old employees that refuse to change, which brought them into the situation in the first place. So if they're unable to change that mindset and be more adaptable, it's very, very hard for a turnaround company to truly turn around. But what are some of the key differences between the two type of stocks is that turnaround companies, typically it is very, very slow for us to notice if they are doing something wrong. So when they turn around, they say they're turning around, but it could take a long time, and they hovers around this stagnant period, and we have no idea whether they are about to do well or they're about to decline. And this is, I think, the key challenge for me, at least, when I trying to spot turnaround situation, which is why I would say that I make more mistake in turnaround stocks compared to going into disruptor stocks. And number two is turnaround stocks. Of course, they tend to have very, very high debt, and that is also something that I try to avoid, and something that I'm not very comfortable with. Because when a company has more debt, any little change in the macro environment would have a bigger impact on the company, right? If compared to if they are just equity funded. For a disruptor company, sometimes when we invest in a company because we have one thesis, very highly likely that along the way that thesis will change because the industry that they're trying to create is still non-existent, or they're trying to change the way that the industry do business. So the end results we might not still see it, right? They would know better than us. So a lot of faith that we have to put in the management that they know what they're doing and they are able to change when the strategy doesn't work. But what is good is that if a strategy doesn't work, we know it quite fast, right? Something that doesn't work, you will see in their financial statement, things change very fast, and you will highlight, you will know that something is not right. But the issue also comes that valuation for this kind of company tend to be very high. So pros and cons between the two. So these are some of the things I wanted to highlight for you guys when you're looking through disruptor company and also turnaround company. If you have any question on this, I'd love to hear it. If you wanted to highlight a turnaround company that you know of, a disruptor company that you know of, I also love for you to highlight here as well. While you put up any question that you might have, I can show you a little bit on the financial statement of this company. So you can see that over the last few years, just from 2000 and to 2020, from COVID period, their revenue grew about 5 times to 15 billion. And just from last year alone, the revenue grew 55%. So you can see that it is still a very, very fast growing company, uh, extremely fast growing company. And it's already profitable. You can see their net profit margin is 42%, very, very high, mainly because, again, I touch on the fact that it is mostly from financing. So margin financing is the key part of their business, which is why they are able to have a very high margin so far. Okay, very good. All right, so if you have no question, I'll just touch a little bit more on the last two segment of our presentation, which is we talk a lot about figuring out how to look into a turnaround stocks or a growth stocks. But at the end of the day, I feel that it comes down to understanding a little bit more about business. And that has at least been my journey and something that helps me r- really understand the stocks that I'm investing in dramatically much better. And I would say that, after reading for the first 5 years, I was reading investing books, any investment books that I can find my hands on, and I would say most of them I read, most of the major ones I read, and then after that, I really focus a lot on just reading business books, understand the psychology of business people, understand how business, what are the businesses that struggle, what are the things that they will face, what are the things that what are they thinking through when they face different issue, and what are some of the politics issue within the company. So I'll introduce to you guys three business books that I feel touch on different aspect of it. One is Hatching Twitter, talking about the story of Twitter and how it was formed. This is basically a story of political struggle within the company and the power dynamics between the company and what happens then. How do you resolve it? Next is Elon Musk by Walter Isaacson. I think this is the most um, detailed description and biology of Elon Musk, and you really have to read it to understand why he turned out the way he is and why is he so unique in a way, and uh, the way he do things is really out of this world. And the next one I would say is good to read is Only the Paranoid Survive by Andrew Grove, one of my favorite business book. And talking about the mentality of good business people should never be complacent. And the death of business most of the time comes from hubris. When the management feel they are on top of the world and that they are invincible, that's where the decline start to happen. And he made the point that, in the business world, only the paranoid survive. You always have to be thinking what could go wrong and make sure that death doesn't face you or your company in the future. So these are some of the interesting books that I wanted to highlight to you guys. Thank you so much for your time. And a lot of the time, when I research a company, it falls back to my key philosophy, which is I feel it's very important for you to form your own philosophy as well if you're investing for yourself, which is the key anchor ideas that you have. For me, it's I always wanted to invest for the long term, and I don't want to be trading in and out of companies. So I wanted to find long term macro opportunities, industries and key markets that can grow for my whole lifetime. And that's where I look at. The next one is focusing on risk management. So to the best way to protect against permanent loss is to focus on high quality companies, high quality stocks, high quality funds. And only through that, then you give yourself a higher chance that your investment doesn't go to zero. Not saying that it will not happen, but you reduce the chance that it could go to zero. And the next one is just being a contrarian, especially during this year. You know, every few weeks, the market sentiment changes. One day they're panicked, one day everybody's happy. So a key part for us as long-term investor is to how to separate that and separate our emotion away in the market and be a contrarian, right? Don't really care what the market is thinking about, focusing on our own path. And only through that, we can build something what I call an everlasting portfolio, something that can stand the test of time and something that we can scale up as uh, our capital grow. And again, my name is Stanley. I work for iFast Global Market, which is a wealth platform that allows you to gain access through all the major asset class that you need to build your financial wealth, including an advisor who will assist you, like myself, to help you build the portfolio that is most suitable for you to meet your financial goals. So if you want to have a chat with me one on one, see how I can help you turbocharge your portfolio, you can fill up our Google form here or just reach out to me from learnwithstanley.com. All my contact will be there. Okay. Oops. So before I go, I'll touch on one last quote that I wanted to share with you guys is that in the age of I feel that as humans, we also need to constantly upgrade our software, and that process is called learning. So thank you so much for your time. My name is Stanley. Till we meet again, invest safely, guys.